Good afternoon and welcome. I'm Chris Andrews, Chief Investment Officer here at Trobe Financial, and we're very pleased to once again welcome a large number of people from across Australia for our quarterly investor call briefing covering the first quarter of the financial year 2016. As you can read on screen, these sessions are designed to encourage investor questions. Whilst we'll answer as many questions as we can on a first come, first served basis, with the sheer numbers attending today, we may not be able to get to all of you. I should point out also, as I always do, that I can't comment on individual portfolios or assets in this context. However, as always, our friendly investor sales team is ready to assist you on these matters if you call our free call national number 1800 818 818. So let's get going. Today's investor call will provide you with our current views of the key issues again driving investment opportunities for you. First, we'll look at the macroeconomic landscape, both domestic and global. Secondly, we will update you on the Australian property market. It's been running hot in Sydney and Melbourne in recent years. Where is it now and where is it headed? Thirdly, we'll provide a financial update on the Trobe Financial business and the terrific financial year and in fact most recent quarter that we've had. And finally, we'll review the quarterly performance of the Trobe Australian Credit Fund investment options. So let's start with our headwinds and tailwinds report, our macro view of the domestic and global economies. So we start with the headwinds, those things that hold back economic and or investment performance. And perhaps the biggest issue for Australia right now is the loss of capital investment as we exit the investment phase of the mining boom. What do we replace that with as we seek to grow our economy? According to the Reserve Bank of Australia, without the capital investment of the mining boom of the 2000s, real GDP in Australia would have been 6% lower. Unemployment over the last few years would have been up to 1.4 percentage points higher, and real disposable income would have been a massive 13% lower. As you can see from the graph on screen, mining investment peaked at over 8% of GDP. That's extraordinary. That was in 2012-13 and was 3 times the level seen in previous upswings. The investment phase of the mining boom has ended, and we're now in the extraction export phase. Now that still pays long-term benefits for our country, but is a much slower contributor to GDP. The second headwind is sluggish domestic growth. Now the graph on screen shows that on a trend basis, Australia's economy has been cooling since 2012, and if anything, is slowing further as we speak. Our highest ever annualised GDP print was in March 1967 at 9%, with the lowest print at negative 3.4% in June 1983. So we're not seeing anything like those figures. Current growth remains at just over 2%, a good result compared with much of the world, still competitive. We see the US as the outlier really at about 3.9%, the UK is at 2.8%, Canada, in many ways a similar economy to Australia, is really struggling at the moment, negative 0.1%. Certainly we're performing better than the EU at their average 1.3%. However, the growth rates of 3 to 4% that we've become accustomed to in previous decades are just not achievable at this point. We are certainly not amongst those predicting a recession, even a technical one. As you can see, the growth prints are well north of that. But to keep real income growth, we are going to need to get the economic growth engine of our economy restarted. Our third headwind is moderating Chinese growth. Now, it'll be a challenge to maintain growth if our key trading partners are themselves slowing down. As Australia's #1 trading partner, China, is experiencing a moderation of its growth rate, that could well be a headwind for our economy. In our view, there's been a bit of hyperventilation about this. No one ever expected or predicted that China would maintain the double-digit growth rate indefinitely. That's completely unsustainable as a nation grows wealthier, as China undoubtedly is doing. The challenge will be to manage what is a new and slower growth rate, even if that rate is still very positive. Now, we've recently been chosen by Austrade to feature in a video promoting the China Free Trade Agreement, and will in coming days be sending this to all our investors, confirming the importance of the Asia region to our country's future. Finally, for investors, if not the general economy, the 15 to 20% decline in the stock market value has also been a significant headwind over the quarter. Between the 27th of April and the end of September, the S&P ASX 200 share price index dropped from 5,982.7 to below 5,000. And this at a time when some investors were just starting to speculate about recapturing the pre-GFC peak of 6,750. It seems that investors suddenly decided that declining company earnings, which are down 6.7% year on year, and plummeting bond yields down from 4% to less than 2.4% in 12 months, had resulted in unsustainable company valuations, perhaps triggered by plunges in equities values across the world, as we've discussed previously. Now, the market's rebuilt a little since then, though still very unconvincingly, and this, of course, is a reminder that all investments carry risk and that equities do present significant issues around capital stability and market risk in particular. So that's the headwinds. On the other hand, on the plus side of the ledger, we do also have some substantial economic tailwinds. First, as Reserve Bank of Australia Governor Glenn Stevens has commented on a number of occasions, the critical housing construction sector, although perhaps moderating somewhat now, has been running hot, driven particularly by higher density housing. Now, this is one sign of an economy rebalancing away from a reliance on mining investment, as it must do to find the growth engine to drive our prospects over the next decade or so. As an aside, Governor Stevens also noted that the relatively sluggish GDP growth figures still need to be reconciled with the generally benign employment outcomes we've been seeing. Now, our house view is that this seeming paradox is caused by the changing composition of the economy. Our sluggish growth is largely caused by the slowdown in the investment phase of the mining boom, as we've discussed. Whilst this weighs on GDP, it has a small impact on employment, simply because mining investment does not employ many people. The jobs engine is the rest of the economy, and this is still growing above trend. That doesn't even touch, of course, on the China Free Trade Agreement, which should be a powerful driver of exports and jobs. We've held off putting that down as a tailwind until it's been enacted, but we are confident that it will be. The second tailwind is the sense that, at least in the broader business sector, conditions are improving. Survey business conditions results, as shown on the slide on screen, are now at their highest level since late 2009. I think it's unlikely you've heard that in the media. Job vacancies have been increasing and have been trending up for 2 years. Australia has 200,000 or 2% more people in employment than we did 12 months ago, predominantly in the services sector. Whilst these outcomes are not uniform across regions and sectors, they are material and they are certainly relevant tailwinds for the Australian economy. Third, and notwithstanding what we've already said about China and the slowdown in the global economy, the numbers are just not backing up the media negativity that you hear in some quarters. Whether you look at the whole of the world, which is on screen, or if I shift graphs to hone in on emerging markets, we see growth that has been only marginally below trend and is projected to turn upwards. What's more, the so-called trend level is disproportionately driven by some very high peak years. We're actually moving very much within the trend band of growth. Both graphs are sourced from the IMF, by the way. None of that should present any significant risk to our economic performance. Finally, when we brief ratings agencies like S&P, Fitch and others, as we often do, we hear a consistent theme. Australia faces budgetary challenges, and we've discussed those in previous calls, but they believe Australia is addressing these challenges and is back on a credible path to surplus. Fundamentally, our position remains, and you've heard this before, on balance, the indicators are more positive than you would think listening to media coverage over the last few years. In fact, Australia's biggest challenge may well be to overcome the negativity that seems to pervade our national psyche at the moment. The bottom line is that the opportunities for Australia and for investors still far outweigh the threats. The economic cycle means that we'll always have highs and lows, no doubt about that, but we're still just at the beginning of the Asian century and we're facing opportunities a nation to grow that dwarf what's gone before. We shouldn't forget that. As recently as this week, RBA Deputy Governor Philip Lowe has taken up the same theme. We cannot let baseless negativity become a self-fulfilling prophecy for the Australian economy. That would be a tragedy. So we turn now to the Australian property market, which is, as usual, a staple on the publishing schedules of our newspapers. And the results are broadly consistent with some changes as to what's been happening over the last 2 to 3 years. Sydney recorded far and away the strongest growth year on year at 16.7%. Interesting, however, for Sydney, the month of September saw a marginal softening of house prices, according at least to CoreLogic RP data, down 0.16% month on month. So, only a very marginal result there. Melbourne was also very strong at 14.2% year on the year, although I should note some caution about these figures. ABS figures for Melbourne are consistently lower and have been for some time. We've only got their end of June print at this stage, but that came in at 7.8% growth year on year, much lower than the CoreLogic RP data print of 10.2%. So that should be borne in mind. Nevertheless, strong growth in Melbourne and Sydney, which drove the 8 capital aggregate to 10.2% year on year. Now, as has been the case for a while, the other capital cities, the other 6 capitals in the 8 capital average, remain in low to negative growth territory. So that's been a relatively consistent picture in Australia for 2 to 3 years. And for the growth that we've seen, particularly in Melbourne and Sydney, there's been a range of factors. First, as has often been mentioned, Australians as a nation, we can't deny it, they have a deep affection for property. Then there's interest rates, which remain at historic lows. So that, of course, increases purchasers' capacity to borrow, although credit growth, it must be said, is still far lower than it's been for 4 decades. But at a very fundamental level, most estimates put housing stock supply well below underlying demand, particularly in New South Wales. And when you get this level of supply, there will always be upward pressure on values. And when this situation persists, as it has done for a number of years, price growth can be substantial. On a forward-looking basis, we note that auction clearance rates have been particularly high in the Melbourne and Sydney markets for some time, peaking in the mid-80% range. September seems to have seen some cooling in Sydney in particular, with softening prices as we've mentioned, and auction clearance rates dropping about 5 percentage points to 69.9% in the last weekend in September. Now that's still a relatively strong result. In Melbourne, the rate also fell slightly and was just a little bit higher at 73%. As you can see on screen, that trend seems to be holding true at a national level. Clearance rates are still high, but seem to have peaked. So looking forward, we'd expect to see moderation, but not necessarily a stop or a reversal to housing price growth rates. We're also occasionally asked whether we see any signs of stress in the sector, and across the industry, the answer is unequivocally no. We say this for a number of reasons. Household net worth is up, while debt levels are up, and this remains something that should be watched. Interest payments as a proportion of income have plummeted from their pre-GFC peaks, as you can see on screen. The household savings rate is also high. It's continued at its very high level, which has been a really interesting feature since the global financial crisis. Households are in fact 28 months on average ahead on their mortgage repayments. What's more, credit standards remain high and if anything tightening, and this is reflecting in low and controlled levels of non-performing assets in the system. This sort of outcome, this sort of approach is reflected, of course, in extremely low loss rates across the industry. You've got the annualised loss rates for prime RMBS on screen. You can see that they fluctuate, but at a consistently low level, which is the experience we've had at Trobe Financial too. For the forward period, we may see a moderation in house price growth, particularly in Sydney, and this should be welcomed. However, we currently see no evidence to suggest that a significant sector-wide correction is imminent. Population growth is likely to continue to put a significant floor under demand, notwithstanding the fact that population growth is slowing somewhat. And our house view is that interest rates will remain low compared to long-term averages. On the other hand, tightening regulatory and capital requirements for banks might reduce credit availability to certain segments of the market. We've seen some recent moves that suggest that maybe having an impact on pricing. Interestingly, this will be to the benefit of other lending institutions who will benefit from decreased competition in the sector. So that's our overview of the Australian housing market. We move now to the update for the Trobe Financial Group. And put very briefly, all key indicators are really positive. So it's been a really pleasing quarter for Trobe Financial. Funds under management has grown strongly, both at a retail and group level. Group revenue for financial year 2015 was very strong at 142.8 million. And as you can see, we're on track to improve that outcome this year. Group equity remains very solid and up over 3 million over the quarter to 93.1 million. Consistent, of course, with our commitment to maintain a very strong balance sheet so that we can be a strong and reliable partner for all our counterparts. So that's the Trobe Financial Group in brief. Now we turn to an update in relation to the Trobe Australian Credit Fund and the investment offerings that we have for our retail investors. You'll note that name change from last quarter. That follows the rollout of our new product disclosure statement, which I encourage you to have a look at. Remembering, as usual, that our fund is not a bank deposit and has different risk return characteristics, and noting again, as we always do, that past performance is not a guarantee of future performance, you can get a sense of the fund's profile by looking at the key indicators on screen. Our cash and mortgages option has been a really terrific performer for investors, outperforming benchmark by 1.2% per annum, with a weighted average LVR of 60.22% and 90-day arrears of 1.3%. It's a very strong profile for investors and is really pleased with the way that's performed. Turning to our pooled mortgages option, it also continues to provide a stellar performance profile for its investors. It's got over $500 million in funds under management now and is outperforming its benchmark by a massive 1.54% per annum, with a portfolio average LVR of 62.6% and arrears of just 1%. It is a powerful offering for our investors and continues to attract a lot of interest and attention. It maintains, of course, its independent ratings and has been Australia's best mortgage fund according to Money Magazine for the last 6 years. And I can tell you that we're now at a group level hitting 2.6 billion in funds under management as at today. So really pleasing outcomes for the group. When considered on an accumulation basis, moving back to the pooled mortgages option, that sort of performance produces a very strong absolute return. Now, obviously, the pooled mortgages option was not designed to outperform equities over the long term, but when you deliver strong monthly returns so consistently, the numbers do begin to add up, and that's what the graph on screen shows. On an accumulation basis, the pooled mortgages option since inception has delivered virtually the same total returns as the ASX without volatility, without timing issues, without capital drawdowns for investors. It really is a very powerful investment. The select mortgages option is also interesting. It's our first peer-to-peer investment options and is in fact Australia's largest portfolio of peer-to-peer investments, with 271.5 million under management in this option alone. Now, we've been managing these peer-to-peer investments for, well, about 20 years, so it's a bit amusing to see peer-to-peer investments written about breathlessly in all the financial papers as the best new thing in funds management. Nevertheless, we'll adopt that clothing, so that's fine. We've got 5,159 investors investing currently peer-to-peer through our platform and achieving terrific results, as the portfolio summary on screen shows. Now, obviously, investors are exposed to the individual assets they choose, but at a portfolio level, you've got an average LVR of 58.3% and arrears, 90-day plus arrears at just 0.1% of funds under management. Now, the shopping list on our website offers outstanding peer-to-peer functionality, and we'll, of course, have more enhancements coming to that website in the months ahead. Also on the peer-to-peer front, and for the more experienced investor, our high-yield peer-to-peer credit option is attracting a lot of attention. We've currently got about 31.7 million under management, predominantly in mezzanine loans. In coming months, we're looking to introduce other credit-based investments into this option, including RMBS and CMBS investments, so more of that in future briefings. Now, that concludes our presentation on our investment options, our overview of the macro economy and the Australian property market. I might now, in the time we've got remaining, turn to questions and answers from our investors. So if we now look, okay, so our first question is from Cameron, and just summarising, aren't Chinese borrowers responsible for much of the property price increase? If China's economy slows and they stop buying, won't house prices crash? Look, thanks, Cameron. Good question. In previous briefings, we've spoken about the Foreign Investment Review Board statistics, FIRB statistics. A recent University of Sydney study replicated that work and estimated that about 2% of annual residential property transactions were to offshore Chinese. At that level, the effect of the Chinese buyer on the market as a whole is marginal at best. Remembering, of course, that the Australian property market is worth about $5.4 trillion, $5.6 trillion, according to the ABS. I do inject just a note of caution here. There are weaknesses in the underlying data. The FIRB stats capture approvals, not completed transactions. So funnily enough, they may actually overstate the actual level of Chinese investment. Secondly, and this is perhaps the more systemic issue, there's been talk for about 12, 18 months that some offshore purchases may be being made illegally, circumventing the FIRB and their data collection. Now, the federal government's been doing some work on this and has conducted a couple of inquiries into the issue. Despite some high-profile individual cases where offshore purchasers have been ordered to sell their property, so far there doesn't seem to have been any systematic rorting uncovered. There's no doubt though, and that was the 2014 parliamentary inquiry, did find that the data on this issue is deficient. So the best evidence we've got is that the impact of the Chinese buyer is not as significant as is often portrayed in the media. On the other hand, it is an issue we need to be keeping our eye on and something need to be working with over time. Okay, so thank you, Cameron. Next question. And we have a question from Erica. Do you anticipate that with the increase of the interest rate of 0.20 basis points for owner-occupiers by Westpac, that other lenders will follow suit? Thank you, Erica. Yes, yesterday the Westpac Bank announced that it would increase both owner-occupied and investment loans by 20 basis points. The reason that was given by the bank for this was that it wished to increase its capital holdings to meet APRA's new capital standards that take effect from the 1st of July 2016. Now, obviously, all lenders look at a range of issues when making these types of decisions, and Westpac's sort of gone out and taken the lead here on this issue. You might recall that we've been arguing for years that this is the sort of thing that we would expect from banks in response to the Basel III Accords and the capital requirements that are being imposed on banks. So this really is for us not unexpected. We've been predicting it for some years, and yes, we would expect that across the system over time we would expect to see similar moves from the banks. Simply put, it's become more expensive for banks to do business, and as a consequence, they have to adjust. Okay, moving on. From Andrew, what of the predictions that the housing market is facing a crash, and what will be the effects on the Trobe Financial's portfolio? I'm just summarising some of these questions. Thank you, Andrew. Look, yes, that's been a bit of a headline in the media, and the media certainly loves these headlines in many ways, and we see them from time to time. The truth is, I think that at the moment it really is just a headline. What we've had is that in recent days, some of the investment banks, and I think Macquarie is one who's been quite prominent, but there's also Credit Suisse out there, they've suggested that the housing market boom in places like Sydney is close to peaking, and it could in fact even soften in the next couple of years. So what's our response to that? Well, first, as I've already said, we agree there are some signs that house prices are coming off the boil, and if you look at the Sydney market, which has been extremely bullish for the last 3 years, we've got CoreLogic RP data, as I said, suggesting a minor decrease month on month in Sydney in September. In our view, this is a good thing. We do like to see the froth taken out of the market. The second point, though, is that anyone who argues that house prices can only and always go up, I mean, they're clearly being silly. Whilst Australian house prices have historically had very few significant periods of decrease, we always build our own portfolios with plenty of excess coverage. So I'll come back to that in a moment. Finally, our view on the economics is, as I've said previously, whilst there's always the possibility of month on month or quarter on quarter softening, and there's no doubt that from time to time specific overheated local markets can even correct more substantially, there is little evidence to support the thesis that we're about to experience a widespread, a substantial or a sustained reduction in house prices. What is far more likely is that price growth rates will moderate and slow, particularly in the capital cities that have been experiencing growth, and I'm thinking in particular of Sydney and Melbourne. So we've got a range of questions here, so thank you for them. Okay, we've got a question here from Greg. How is Australian unemployment affecting the loan portfolio? Appears not to be. Yes, that's well. Okay, so the first thing is that the ABS has just reported that unemployment's steady at 6.2%. So that's a really good outcome. I mean, look, unemployment data is another area where there has been some concern by statisticians about its reliability. So rather than looking at month-by-month prints, we look for the ongoing trend. But this print is very much in line with the ongoing trend, which is, as I said, surprising some economists because it doesn't seem to reflect the slower economic growth, and we've discussed our house view as to why that is the case. The effect that this level of unemployment is having on portfolios is, frankly, there is no effect. These levels of unemployment are certainly levels that loan portfolios at Trobe Financial and indeed across the country, as you saw from the RMBS statistics earlier, these portfolios are performing very low. Arrears levels are sort of on a trend basis, if anything, moderating slightly. Loss levels are low and controlled. So what we're seeing is a really healthy environment for borrowers. And it's worth reflecting on that too in the context of our discussion on housing prices. Housing prices, of course, are relevant to a lender because a house is taken as security for a loan. But the house price doesn't become an issue unless and until a borrower starts to default on their loan repayments. And whilst unemployment remains low, it's unlikely that the economy will see that on any sort of significant or systemic basis. Reminding ourselves, of course, that as I said, from RBA stats, as I said earlier, the average homeowner is 28 months ahead in their mortgage repayments. And it was interesting to see the discussion in the wake of the GFC, which actually starts to see a long time ago now. When we talk to some of our younger employees, they struggle even to remember that time. But for those of us who do remember it well, the stimulus package, the mails that were sent out in the cheque to households across Australia, whilst the government was going hard, going early and going households, it was found over time that a lot of those borrowers were using, a lot of the households were actually using those cheques to pay down debt. Now that combined with the very high savings rate, which we've seen since the GFC, has meant that household balance sheets are really in a strong position. So, in terms of our overview of where our portfolio's headed, the stresses, the issues that we're watching in terms of arrears, we're seeing a very positive environment still. And I do say if interest rates do move upwards, whether driven by the RBA or whether driven by individual lending institutions, I don't see that having a real significant impact on arrears across portfolios. Okay, I've got a question about the housing market on the Gold Coast. Wasn't included in the capital city results. That's from Mark. Thank you, Mark. Look, the Gold Coast and in fact all of southeast Queensland has seen a sustained period of underperformance. There's no doubt about that. It really crashed in the wake of the GFC and has been down low ever since. There's been a number of apartment complexes built where there's been difficulties in getting rid of those units. That's the sort of thing, if I say, that is not atypical. You see that in some markets in Australia, and the Gold Coast is one of them, where you see periods of boom and periods of bust. The best view at the moment, we're hearing quite a few commentators, and we're seeing quite a bit of activity now in southeast Queensland. There is a view that the floor has now solidified under the Queensland housing market, the southeast Queensland housing market, and you may expect to see price increases over the next, say, 2 years or so in southeast Queensland. Now, at that point, that's really great list of questions. I see there are plenty of others there, so I will undertake to get to you. I'll get in contact with you separately and answer the questions that I haven't managed to get to. But for now, that concludes our presentation. I'd like to say, firstly, thank you for your attendance. As always, we really value all of our investors and partners and appreciate the opportunity to speak with you. We look forward to you participating in future briefings. For now, I hope that all your investing is profitable and wish you all the very best for a good day. Goodbye for now.